They made a mistake, a massive multi-billion-dollar calculation error, and for the last 48 hours, the largest banks on Wall Street have been fighting a desperate battle. Their mission was simple: destroy the price of silver before the year ends. They wanted to crash it down. They wanted to trigger panic selling. They wanted to break the spirit of every investor who believed silver was going higher. And for a moment, it looked like they won. They hammered the price all the way down to $70, $50. It looked like a total collapse. It looked like the rally was finished. But then something happened that wasn't part of their plan. The selling stopped. The price bounced back. And right now, as we move into the final hours of 2025, silver is trading at $71.83. We're seeing what's called a doji candle on the daily chart. That's a technical sign of indecision. It means the selling pressure has been completely exhausted. The banks threw everything they had at this market, and the market absorbed it all. Here's what they didn't realize. By smashing the price, they didn't kill the rally. They accidentally created the greatest buying opportunity for their competitors. They lowered the price for China, they lowered it for Samsung, they lowered it for the very entities that are draining the physical vaults dry. In this analysis, we're going to expose the bank trap. We're going to explain why the drop to $70 was a regulatory flush driven by year-end accounting rules, not by actual market fundamentals. We're going to look at the Shanghai premium, which is still trading dollars above the US price, proving the physical market is screaming for metal. And we're going to analyze the setup for January 2nd. The banks cleared the deck, but by doing that, they left the door wide open for real money to flood in. The smash failed. The floor is set. But what you're about to discover is how this mistake could cost them control of the entire market. To understand why this was such a catastrophic mistake, you need to look at what happened at $70. This was the breakout level from weeks ago. It was the ceiling that held the price down for months. When the crash happened yesterday, the price went straight to $70, $50. And then it hit what looked like a wall of concrete. It didn't drop to 68s. It didn't fall to 65s. It stopped dead in its tracks. This tells us something critical. There's a strategic bid sitting right at $70. There are buyers, industrial buyers, sovereign buyers, who have automated orders to buy everything at that exact level. The banks tried to push it lower to trigger a full panic. But instead of panic, they found massive liquidity. They sold their cheap silver to what traders call strong hands. They transferred ownership from paper speculators to physical accumulators who buy based on value. And here's why that's a fatal error for a short seller. When you're covering short positions, you want to buy from weak hands, people who panic and sell at any price. You don't want to sell to strong hands because strong hands don't sell it back to you. They take it off the exchange, they melt it down, they vault it away. By driving the price to $70, the banks accidentally accelerated the drain of physical inventory. They made it cheaper for the entire world to take the metal away from them. You won't believe what the chart is showing right now. Let's look at the volume profile of the recovery. We're currently trading at $71.83. We've recovered nearly $1.50 from the lows. The chart shows what's called a long lower wick. In technical analysis, a long lower wick is a sign of rejection. The market went down, looked at the lower price, and rejected it. It essentially said, no, too cheap. This rejection is happening on the last day of the year, which is critical. It means that despite all the pressure, despite the tax selling, despite the G-SIB liquidity flush, the market wants to close the year high. It wants to close above $70. This preserves the bullish trend on both the monthly and yearly charts. As long as we stay above $70, the chart damage is minimal. It's just a flesh wound. The structural integrity of the bull market remains completely intact. But there's a boring bureaucratic reason behind this crash that nobody's talking about, and it explains everything. We need to talk about something called the G-SIB surcharge. This is the dry, bureaucratic reason behind the entire crash. G-SIB stands for Global Systemically Important Banks. Under Basel III regulations, the biggest banks in the world get scored on their systemic risk at the end of every year. The score is calculated based on a snapshot of their balance sheet on December 31st. If that score is too high, they have to pay billions in extra capital requirements for the next year. So every year in late December, the banks have a massive fire sale. They sell assets, they close derivative positions, they shrink their entire book. They're not selling silver because they think silver is going down. They're selling silver because they need to appear cash heavy and asset light. It's what I call a regulatory hallucination. They're pretending to be smaller than they actually are just to fool the regulators. But here's the part that changes everything. On January 2nd, the snapshot is over. The regulations relax. The banks can go right back to normal business operations. And what is normal business? Trading, hedging, buying. So the selling pressure we saw yesterday and today is completely artificial. It has an expiration date built in. That date is tonight. Once the ball drops at midnight, the G-SIB pressure vanishes entirely, and the natural forces of supply and demand take over again. This is exactly why the drop to $70 was a bear trap. It lured retail traders into selling at the absolute bottom. They panicked and thought, oh no, the banks are dumping everything. No, the banks were dressing the window, and tomorrow they're going to change their clothes right back. If you sold yesterday because of this regulatory flush, you got played by the accounting department of JP Morgan. But wait until you see what's happening in Shanghai right now. While New York was crashing to $70, what do you think Shanghai did? Yes, Shanghai dropped too. It fell from $82 all the way down to $75.58. A massive drop. But look closely at the spread between the two markets. New York is at $71.83. Shanghai is at $75.58. The difference is roughly $3.75. Even after the crash, silver is still nearly $4 more expensive in China than it is in the United States. The arbitrage gap did not close. It narrowed, yes, but it's still wide enough to drive a truck through. This means the sucking sound is still there. Metal is still flowing from west to east. The banks smashed the paper price, but they cannot smash the physical reality that China desperately needs this metal. And what's keeping gold from collapsing tells you everything you need to know about what happens next. Let's discuss what I call the gold anchor. Gold is currently trading at 2,246. It's down marginally. But compared to the wild volatility in silver, gold is a rock. Gold is holding the line. It's refusing to break down completely. This tells us that the monetary premium is still active across the entire precious metals complex. The world is still worried about debt. They're still worried about currency debasement. They're not selling their insurance policies. They're just adjusting their hedge positions. Silver, being the high beta asset, swung wildly. It dropped 10% while gold only dropped 1%. This is completely normal. This is the nature of the beast. But because gold held strong, silver has a safety net underneath it. Silver cannot collapse if gold is sitting at all-time highs. The ratio between the two prevents it. If silver got too cheap relative to gold, the algorithmic trading bots would automatically sell gold to buy silver. So gold is acting as the big brother, protecting the little brother from the bullies on the playground. Now let's look at the volume patterns. The volume on the crash was extremely high. That was the liquidation phase. But the volume on today's bounce is what traders call constructive. It's steady. It's accumulation. We're not seeing panic buying yet. We're seeing value buying. Smart money is quietly stepping in and picking up contracts at $71. They're building positions for the new year. This quiet accumulation is often far more bullish than a noisy spike because it means the weak hands are completely gone and the inventory is moving into strong hands that won't sell for a quick buck. We also need to consider the tax loss angle one final time. Today is the absolute last day to book a loss for the 2025 tax year. If you bought mining stocks at the highs, or if you bought silver at $83, you might sell today just to get the tax write-off. This creates what's called non-economic selling. People are selling not because they want to exit their position, but because the tax code gives them an incentive to do it. Tomorrow, that incentive completely disappears. In fact, the incentive actually flips in January. People have fresh tax room available. They can buy without worrying about the tax bill for another 12 months. So the tax headwind becomes a tax tailwind on Friday morning. But where we actually stand right now is more important than most people realize. So where do we stand? We're bruised. The chart looks messy. But the core thesis is completely unbroken. The banks made a critical mistake by pushing the price this low. They thought they could break the markets back. Instead, they just cleared all the leverage out of the system. They reset the RSI indicator. They cooled off the overheated sentiment. They accidentally gave the bull market a second wind. We were getting dangerously overheated at $83. Now at $71, we're technically oversold. From a pure technical perspective, this is actually a much better place to launch a sustained rally from. The fuel tank has been refilled. The weak hands have been shaken out. The stage is set. But what's about to happen in the next 48 hours will shock even the most experienced traders. We need to look forward to the first 48 hours of 2026. While the banks are catching their breath after the G-SIB squeeze, a new giant is waking up, the pension funds. We've talked about the January effect before, but now the setup is completely locked in. The year is closed. The data is final. Silver was the best performing asset class of 2025. It beat the S&P 500, it beat bonds, it beat real estate. This creates a mandate for institutional investors. Pension funds and endowments operate on extremely strict rules. They chase what's called alpha, which means performance. When they come back to the office on Friday, January 2nd, They have a fresh allocation of capital to deploy. They look at the performance leaderboard of 2025. They see silver sitting at the very top, and they ask one simple question. Do we own enough of this? The answer is almost always the same. No, we own zero. So the great rebalancing begins. Trillions of dollars of passive capital will start to rotate. They'll sell a little bit of their overvalued tech stocks. They'll sell some losing bonds. And they'll buy the winner. They'll buy silver. This buying is fundamentally different from the bank buying we saw today. The banks bought to close a short position. They were neutralizing risk. The pension funds are buying to open a long position. They're accumulating. They're taking supply off the market and locking it away in a vault for 10 years. This removes what's called the float. When you combine bank short covering with institutional long accumulation, you get a 1-2 punch that can send the price absolutely vertical. And the signal that confirms all of this is already printed on the chart. Let's look at the yearly candle. Technical analysis works on different time frames, daily, weekly, monthly, but the most powerful signal of all is the yearly chart. We just printed a massive green candle. Depending on your data feed, it's likely what's called a Marubozu candle, opening near the low and closing near the high. This indicates total control by one side. The bulls completely own the year. For a trend-following algorithm, for the robots that manage sovereign wealth funds, this is a buy signal of the highest possible order. It tells the robot that the long-term trend has definitively shifted from bearish to bullish. These robots move slowly, but they move mountains. They will be programming buy orders for the entirety of 2026 based on this single candle. We're talking about a secular shift in capital flows that will last for years. Now let's go back to what's happening with the physical dealers. While the paper price rallied $4 today, did the physical market loosen up? Did premiums collapse? No. We checked the major dealers. Premiums did not drop. Inventory did not suddenly flood back onto the shelves. Usually when price spikes, people sell their old coins back to the dealer to lock in profits. But today, dealers are reporting more buyers than sellers. Even at $75, the public is buying. They're chasing the momentum. This means the secondary supply, the scrap market, is not functioning as a brake on the price. People are hoarding their silver because they think it's going to $100. And they're probably right. If the public refuses to sell, and the mines refuse to sell, and the banks are now forced to buy, where does the metal actually come from? It comes from the price going higher. It has to go high enough to break the psychology of the hoarder. $75 didn't do it. Maybe $100 will. But there's an opportunity hiding in plain sight that most people are missing. Let's look at the mining stocks. Mining stocks had a brutal day yesterday. They crashed right along with the metal, but today they're flying. Investors are realizing that $75 silver is an absolute bonanza price for producers. Companies like Hecla and Cure Mining are printing free cash flow yields of 20% or 30% at these levels. But here's the secret that Wall Street doesn't want you to know. The mining stocks are still massively undervalued relative to the metal itself. And what's coming in 2026 makes this even more explosive. Historically, when silver hits a new high, the miners should be trading at all-time highs too. They aren't. They're lagging significantly. This is what's called the catch-up trade for January. As generalist investors look for ways to play the silver boom, they'll buy the stocks because they can't actually buy the physical metal. This wall of money will hit the tiny mining sector like a tidal wave. We could see small-cap silver miners double in value in just the first month of the year. We also need to consider the geopolitical calendar for 2026. The debt ceiling fight starts in February. The BRICS currency summit is scheduled for later in the year. U.S. political tensions are escalating. The macro environment is specifically designed to create uncertainty. And uncertainty is the pure fuel for precious metals. The banks know this. That's exactly why they were so desperate to close their short positions today. They know that holding a short position into 2026 is financial suicide. They de-risked. And by de-risking, they essentially admitted that the bearish case is completely dead. They're no longer willing to bet against silver. If the banks themselves won't bet against it, who will? Nobody. That's exactly why the price is rising. The short interest is evaporating in real time. Let's talk about market depth. On December 31st, market depth is extremely thin, but on January 2nd, full liquidity returns to the market. Usually liquidity dampens volatility, but in a shortage situation, liquidity reveals the truth. When the full volume of the market comes back online, we'll see the true depth of the order book. I suspect we're going to find that the sell side is completely hollow. There are no large blocks of silver available for sale until we hit $80 or $85. The market will have to gap upward just to find available liquidity. So don't be surprised if we see another massive gap up on Friday morning. The momentum is simply too strong to stop now. The psychological barrier of $70 is gone. Now the market is looking straight at $80. It's the next round number, the next magnet pulling price higher. And with the Shanghai price already flirting with $80, the arbitrage bots will push us there quickly. But the specific price targets for next week reveal something even more shocking. We're watching the convergence of the paper price and the physical price happen in real time. For years, they were completely separate markets. Now they're merging, and they're merging to the upside. The paper market is being forced to accept the reality of the physical world. This has become what traders call a blue sky breakout. When an asset closes at the highs of the year, it sends a clear message to every technical analyst in the world. It says, the sellers are gone. There's no overhead supply. There's nobody waiting to get their money back at $76 because nobody has ever bought at $76 before. Everyone is sitting in profit. And when everyone is in profit, they tend to hold. They want to see how high it can actually go. So let's look at the specific technical targets for the first week of 2026. We use Fibonacci extensions to predict where the price might pause. We measure the move from the breakout at $50 to the consolidation at $65. The first major target is the 1.272 extension. That lands squarely at $85. This is not a random number. $85 is the level where the algorithms will likely take their first breath. They'll buy aggressively until we hit that mark. So if you're watching the screen on Friday, January 2nd, don't be surprised if we gap up and run straight toward $80. The magnetic pull is extremely powerful, but there's a secondary target that sounds almost impossible, the psychological century mark at $100. In a runaway market, a parabolic market, technical resistance levels often get blown away like tissue paper. The market completely ignores $85 and goes straight for triple digits. This happens when FOMO, fear of missing out, overpowers profit-taking. We're seeing signs of extreme FOMO building in the retail sector right now. Google searches for how to buy silver are spiking. YouTube views on silver videos are going vertical. The public is waking up. And unlike the banks, the public doesn't sell to hedge gamma or manage risk. The public buys and holds. They bury it in the backyard. This removes the metal from circulation permanently. Now let's discuss what I call the danger zones, because I'd be irresponsible if I told you it only goes up from here. The banks took a beating today. They lost billions of dollars. They're wounded animals, and wounded animals are extremely dangerous. In the first weeks of January, they might try to re-short the market. They might try to use these higher prices to put on new bearish positions. They'll attempt to create what's called a double top pattern. If they succeed, we could see a sharp correction back to $70. But here's exactly why their re-shorting strategy is doomed to fail this time: the physical vacuum. You simply cannot short a market that has no inventory available. If the banks sell paper contracts to drive the price down, the arbitrage bots will immediately buy that paper and demand physical delivery. They'll drain the last remaining ounces from the COMEX vaults. So any attempt to crash the price will only accelerate the potential default. The banks are trapped in what game theory calls a prisoner's dilemma. If they attack, they lose the metal. If they do nothing, they lose the money. Let's look at the industrial inventory cycle. We mentioned this briefly, but it's absolutely critical for Q1. In January, industrial companies report their earnings and their inventory levels to shareholders. We expect to hear CEOs publicly complaining about material shortages. We expect to hear Samsung and Tesla say, "We're having serious trouble sourcing silver." When those headlines hit the Bloomberg terminal, it validates this entire thesis for the whole world. It moves the story from speculation to documented supply chain crisis. Capital flows will rotate out of tech stocks and into commodity stocks. This rotation is the engine of what could become a multi-year supercycle. We also need to watch the interest rate narrative very carefully. The Fed is claiming they have inflation completely under control. But silver at $75 says they're lying. Silver is the truth teller. It's saying that inflation is structural, not transitory. As silver rises, it forces the bond market to price in higher long-term inflation expectations. This kills the bond market. And as bonds die, money flees directly to silver. It's a self-reinforcing feedback loop. The higher silver goes, the more it proves the system is broken, which drives it even higher. So what should your strategy be for the first week of the year? First observation: don't rush to sell anything. The first week of January is often the trendsetter for the entire year. If we close the first week green, statistics say we'll have a massive up year. We want to see follow-through. We want to see the buying continue on January 2nd, 3rd, and 4th. If we see that kind of sustained buying, the all-clear signal is given. Now, silver is probably a larger percentage of your net worth than it was a month ago. This is good, but it also means your risk has increased mathematically. If you're losing sleep, if you're checking the price every 5 minutes, you might be over-allocated emotionally. But here's what you absolutely should not do. Don't sell just to reduce anxiety. Anxiety is simply the price of admission to markets like this. Instead, focus on the fundamental value. The market is trying to reprice silver to a level that actually balances the books. We're not there yet. We're just moving from absurdly cheap to very cheap. Don't sell a very cheap asset just because it used to be absurdly cheap. Wait for it to reach fair value or expensive, and expensive is hundreds of dollars away from here. Tomorrow is New Year's Day. The markets are closed. It's a day of reflection, a day of calm before the storm. But on Friday, January 2nd, the doors blow wide open. The year 2026 begins, and it begins with a setup that is statistically perfect for a vertical move. Friday morning, January 2nd, this is the day the pension funds we talked about actually push the button. They have their new allocations approved, they have their new budgets ready, and they're looking at a chart that just closed at all-time highs. What happens at 8 a.m. Eastern Time on Friday? We're likely to see a significant gap up. The momentum from today's close will carry over. The algorithms that buy strength will be fully active. The shorts who didn't cover today will be desperate. We could see silver open at $77 or even $78. If this happens, don't chase it with leverage. Gaps are volatile. They can fill. But understand what the gap represents. It represents a severe shortage of sellers. Nobody wants to sell on the first day of the year. Everyone wants to buy. That imbalance forces the price to literally teleport higher. If we see a gap up on Friday, it confirms that 2026 will be a runaway market. It means the price discovery phase is accelerating. We're moving away from the base and into the spike phase. I checked the major dealer sites. The price of a silver eagle is still hovering near $40. The spread is $15 over spot. This is the truth teller. If dealers believed that $75 was the top, they would be lowering premiums immediately to dump inventory. They would be trying to get rid of coins before the crash, but they aren't. They're keeping premiums high because they know that $75 is the floor, not the ceiling. They know that replacing that inventory in January will cost them $80 or more. The physical market is trading in 2026, while the paper market is still stuck in 2025. This year, the market has to find a price that destroys demand, and that price is not $75.